Good morning, everyone. Today we are going to be starting off with study unit 1. And when you look at study unit 1, is part of topic 1, where we are being introduced to risk management. So study unit 1 is part of topic 1, where we are being introduced to risk management. So you see that the way the structure study unit 1 is that the first give us the different case studies which make us ask the question. So when you look at the disasters that these companies that are being mentioned in the case studies have faced, so is it a fair assessment to blame a risk management in the disasters that the different companies would have faced as well? And what parameters are we going to be able to use to make that assessment to say, in this case, we can all agree that if these parameters are met, this is when we can now say risk management has failed. So that's what we're being introduced to study unit 1. Then under study unit 2, so under topic 1 as well, you will see that after doing that assessment, we are now going to now start moving on to say, so what is the risk management of the future? How should organizations or enterprises structure risk management going into the future? And what would be the difference between the way risk was being managed traditionally and the way risk should be managed going to the future? So you will see that this is mostly what we're going to be looking at in study unit 2, which is basically leading on from study unit 1, so that we now know, say, okay, fine. So what should we consider and how should risk be managed going to the future, so that at the end of the day, risk should not just be managed from a single department, as a single department perspective. It should also be seen as a comprehensive function where the risk management department should be working hand in hand with the different departments of the organizations. And if the organization has different subsidiaries as well, how are we going to be able to manage the different risk exposures of the subsidiaries and quantify the risk exposure of the subsidiaries, so that we're able to now assess the overall risk being faced by the organization and manage that risk from a perspective of what? Enterprise risk management. So that's what we're going to be looking at as well in study unit 2. Then study unit 3, we are going to go forward under topic 1, which looks at risk management as well. We are now going to say, from a risk management perspective, how do we quantify the risk? And how do we now assess risk and account for that risk as well? Because we know that when you look at the accounting equation, remember with the accounting equation, we always used to say your assets is equals to equity plus liabilities. But now we are saying that when you look at risk management going into the future, there is also another. So we're saying to finance the assets of the business, we need to finance them through equity, which is through the owners of the contribution by the owners of the business, through liabilities, which is contribution by third parties. But now, in case this paid-in capital is not going to be enough to mitigate any loss events that might arise from what? The losses that we have. Because remember, at the end of the day, we need to try to protect the going concern of the business by ensuring that any losses arising from the asset side of the business should be mitigated, so that the business is able to continue as a going concern. So this is where we're now going to be talking about what? Risk. So this is the element that we're going to delve deeper and in analyzing, and also from an accounting perspective, using numbers as well, analyzing exactly why we say risk capital is relevant when it comes to the capital of the business. So that's what we're going to be looking at in study unit 3. So you see that in all these activities under topic 1, we're being introduced to risk management to say, so how do we now look at risk management? And remember, specifically from a risk financing perspective. That's why you see that from a financing perspective, we are now starting to take into account risk capital as well. So this is where we're now going to be saying, apart from looking at it from a general risk management perspective, how do we now streamline and analyze it from a risk financing perspective? So that's what we're going to be looking at in under topic 1, which looks at or introduces us to risk management. Are there any questions so far? Any questions? Please note, for Rsk4803, there is no specific textbook that we are expected to use. So you will see that in your study guides, when you look at the different topics that are expected to be covered, the lecturer indicates the study units and the articles that needs to be covered under each study unit. So that's how we're going to be going through RSK4803 when it comes to going through the curriculum. So remember, in the previous class, as I stated, if you went through the video, if you attended the class as well, I emphasize that you should make sure that by today's class you would have downloaded the articles, you have the articles, and you have your study guide which shows you which topic is being covered and which is the next topic that is also going to be covered as well. So you must make sure that every class that we go and have, we always have those things in handy, because that's what we're going to be using as we go through the curriculum as well. So please ensure that you have your material in order. Now, before I go into the detail of study unit 1, please note that I'm fully aware that registration is ending on the 31st of March. So today's class, we are going to cover study unit 1, but we're not going to move too fast because there is quite a lot of students who are still to join us as well, because the registration is ending 31st of March. So because of this, to avoid disadvantaging other students, but at the same time, the class must move on. Only for today's class, we're not going to be moving too fast, although we are going to make sure that we cover as much ground as possible reasonably. But remember, your timetable is already there, as I've communicated as well previously. Your timetable is already there. The timetable for when we're going to be having the classes between now until end of October, the timetable is there. Also, over and above that as well, please note that expect some additional classes to be added on to your timetable. So you should expect some additional classes to be added onto your timetable, because no matter what happens, we need to make sure that by 31 October, we are done going through the curriculum. The only thing that we're worrying about is now going to be revision from November until you write your exams in February. Also, when it comes to the assignments, we are going to deal with the assignments together. How we're going to approach that, I'll go through that with you as we go through the assignments as well. So when you look at topic 1, remember we said topic 1 introduces us to risk management. So topic 1 introduces us to risk management, and here they say the lecturer says the aim of this topic is to provide an overview of risk management and the role of risk financing in risk management process. So that's the aim of this topic. So which means for us to have said, when remember there are different section or different case studies that they're giving us in unit 1 as well, where we now need to start asking the question. So when you look at the disasters that these companies have faced, is it a fair assessment to say risk management failed in that case? So in that case, the first thing that are going to be highlighted to, as well as we go through study into 1.5, is that we are going to be introduced to exactly, so what really is the role of risk managers within an organization? And what are the parameters that are going to be used to make a fair assessment, where we can say, in this case, it is fair to say risk management has failed, or it's not fair for us to come up with a conclusion to say risk management would have failed as well. So they give us a couple of case studies, which starts making our brains run, just to start asking ourselves, so when you look at these case studies, is there a fair assessment to say risk management has failed? So when you look at the study unit 1, topic 1, where we look at risk management, the first, under study unit 1, the content of study unit 1, the lecturer says, we're looking at lessons not learned. So we're looking at lessons not learned. Then from there, in study unit 2, we're now being introduced to enterprise risk management, which is trying to address what has been highlighted in study unit 1. So enterprise risk management is now being used to address the situations, to address the issues that would have been highlighted in study unit 1. Then from there, we're also looking at analyzing the capital of the enterprise, where we are being introduced to risk capital. Now, please note, under the overview, I'll just go through the overview that the lecturer indicated here. I'll just go through the overview that the lecturer has indicated, but in summary, they are basically discussing the issues that have been seen when you look at specifically, for example, in South Africa as well. So here they say we begin this module by trying to understand why apparently well-managed enterprises ran into serious financial problems. While some of them were able to recover, others were not that fortunate. Although we mainly use examples of international enterprises, the principles remain the same for any enterprise. We refer to newspaper articles about state-owned enterprises in South Africa, but as these are still disasters in the making, we cannot include the reports on the outcome of investigations. There are parallels between the underlying causes of the demise of private enterprises and SOEs, which is the state-owned enterprises. However, the action or reaction to corporate failures usually is brutal and swift. Private enterprises have basically two choices when they experience significant financial loss: bankruptcy or obtain funding from the investors to continue business. In contrast, the losses of SOEs in South Africa are funded by the National Treasury. So in effect, funding incompetent and loss-making SOEs is stealing from the poorest of the poor, as funds that would have been utilized for the upliftment of communities, improved health services or education, are now used to bail out inefficient entities. So the following study unit introduces the concept of enterprise risk management. The other modules in this qualification covered the risk types such as operational, credit, and market risk. But as this module is focused on financing of the enterprise risks, it is essential to have a deeper understanding of how the enterprise is governed, capitalized, and financed pre-loss, which is before the loss event has happened, and then post-loss, then after the loss event has happened as well. And we're going to be looking at this after study unit 11. That's when, after study unit 11, that's when we're going to be looking at this. Then they also say the risk appetite of the enterprise is also important, as it will eventually drive the outcomes of decisions. So the last study unit in this topic covers the concept of capital, risk capital, and capital budgeting. So the underlying principle is that capital is not a free good and is unlimited, is in unlimited supply. And in what? So capital is not a free good and in unlimited supply. So which means that there is a limited supply of capital. So it is therefore important for the enterprise to have a good understanding of its costs of capital to determine which projects to accept or reject. So again, the risk appetite of of a very good so the risk appetite and a very good understanding of the risks of the enterprise are critical in the process of the enterprise, as the enterprise needs to optimize spending, and that is getting the most bang for their buck. So which means the goal of the so which means this leads us on to the question. If you still remember, for those who are studying finance, who are in the finance industry, or those who did finance when they're doing the undergrad as well, there is always that one question that is being asked: what is the goal of the firm? The goal of the firm is to maximize shareholders' wealth. So that is the main goal of the firm, which means that in everything that the enterprise does, they always have to ask themselves, what is the goal of the firm? So which means, remember, we are being introduced to the fact that for, for every activity that the organization is going to be doing, they are also going to be asking themselves that question as well. What is the goal of the firm? So which means in all the risk financing decisions that the organization is going to be making, at the end of the day, the goal should always be to maximize shareholders' wealth. And how does the organization, so how do they maximize shareholders' wealth? By maximizing the shareholder value. So which means in everything that they do, and every risk financing decision that is going to be made as well, the question is this going to be leading us on to maximizing the value of the firm? If it's going to be maximizing the value of the firm, then it's a good economic decision, which means that we can go ahead. When it comes to study unit 1, please take note. Remember, study unit 1, the lecturer says the aim of this study unit is to provide an overview of events that led to the demise of a number of enterprises. So we are studying the events that led to the demise of a number of enterprises. So when you look at this information as well, please take note. On study unit 1.1, 1.2, 1.3, and 1.4. My advice is, even if you look at study unit 1.1, study unit 1.1 has got a list of so many articles that the lecturer is asking you to go through. And if you open just one article that is given there, for example, if you look at ESCOM as well, one article has got pages, you see that there's 1.1 here, the 1.1. So on look at 1.1, when you look at this link as well, there's a financial report which has got so many pages that one would be expected to go through. My advice is peruse through these articles: 1.1, 1.2, 1.3, 1.4. Peruse through them, familiarize yourself with those articles, but don't get lost in those articles by trying to understand figure by figure, value by value, because going into the exam, when you look at historically how the lecturer has asked questions based on this, there's never been a specific question being asked when it comes to, for example, specific to say ESCOM or HHI or any of these companies that I've mentioned, like for example, ComA and all these other companies as well. Going to the exam, normally, if they are going to be giving you a question based on the case study, they will give you the case study. Then, based on the case study, they will ask you questions, or they will ask you to answer the questions based on the case study. So you will see that the case study that they're giving us here for unit 1.1, 1.2, 1.3, and 1.4, they are being used as a way of making you start wondering and asking the question. So in this case, is it a fair assessment to say risk management failed? So traditionally, we have never really gone through these articles in detail because we're not expecting specific questions to be asked based on these articles. So my advice is go through these articles, but don't spend too much time dwelling too much go through these articles so that from a practical application perspective in the real world, you are able to understand and apply your knowledge. From now, the knowledge that we're going to be accumulating from what we're going to be learning from Unit 1.5 onwards, you can now be able to use it now to apply these real-world cases as well. So, on Unit 1.1, they give us the case study of ESCOM, where you look at under the heading, suspending the principles of financial management and governance and transforming energy the ESCOM way. We have seen the historical issues that ESCOM has suffered over the years as well. So they are giving this as a typical example of a case study for us to say, so in this case, is it a fair assessment to say risk management did fail? So go through this article. I'm not going to go through this article with you in detail. Reason being, the expectation is we are not going to be expecting you to be asked the specific questions based on ESCOM in the exam, because yes, they're giving us this as an example for us to be able to discuss, to say, yes, when you look at the situation that ESCOM is faced, is it fair? Is it a fair assessment to say the risk management function within ESCOM is what has failed? But for you to be able to understand, to answer that question, we need to go through Unit 1.5, because Unit 1.5 gives us the parameters and they give us the roles and responsibilities of the risk manager. And then from there, we'll be able to now answer that question to say, so after going through this, would it be a fair assessment to say, if you look at the failures of a particular company or the financial difficulties the particular company is going through as well, would it be a fair assessment to say, in that case, we can blame risk management function? Unit 1.2, they also give us the case study of Bearings Bank. And when you look at the case study of Bearings Bank, remember these case studies, go through them, but we are not necessarily, for Rsk4803, we are not necessarily expecting a specific question to be asked based on Bearings Bank. If there is, what they will do, they will give you a case study, and then after giving you a case study, you analyze that company as well. So when you look at Bearings Bank, this is where you look at the case study where we see the trader Nick Leeson. And when you look at the trading activities of Nick Leeson, he was operating in Singapore, and in the operations or in his trading activities, there's a couple of loopholes that were identified in the case study, where you find that Nick Leeson is operating on both the front end, the middle office, and also the back office. He had influence on all these, and because of those loopholes, and the management was just so happy that he's making them billions in profits, and because of this, they decided that, you know what, this is our money-making machine. He is making a lot of money for us, so let him continue making money. But now, when the losses start accumulating because of certain things that he did wrong as well, he was able to actually start hiding those losses as well in a particular account. And when he was hiding those losses in a particular account as well, you find that it ended up having a situation where the Bearings Bank ended up being declared bankrupt, and an institution which was more than 100 years old ended up being foreclosed as well. So when you look at these activities, the same question is being asked as well. So is it a fair assessment to say within Bearings Bank, can we fairly assume that in this case, the risk management function did fail? So go through the article, and in understanding the article, this is how we are now going to be able to answer the question to say, is it a fair assessment to say the risk management function have failed? But remember, for us to be able to understand that, we need to go through Unit 1.5. 1.3 is also another case of this insurance company, this insurance company from Australia. And when you look at the insurance company from Australia, they uh, the the board was overstating what they could do within the basically were overstating what they could do, and you find that the auditors, the auditors, the internal and external auditors, they were a bit compromised in their auditing activities, and you also find that the auditors were also over and above doing the audit function. They were also being paid for advisory function as well. So which means that there was quite a bit of transgression when it comes to the roles and responsibilities that were being given there. So which means that because of this, you know that we have seen that case as well here in South Africa. I can't remember the name of the company. It's one of these audit firms where you find that because of the roles of their duties and their roles as well, and their fight, the way that they were being paid as well was basically based on exactly what on their duties, where they were both playing the audit role and also the advisory role as well. So which means that because they were making money from the audit roles and advisory roles as well, you find that they will end up being compromised. And because of this, is it a fair assessment now to say from a risk management perspective, there was a risk management failure? So my advice is go through these articles. Don't spend too much time on these articles, because remember, if ever a question is going to be given based on a particular case study, they are going to give you the case study. Then after giving the case study, they will now ask you to make the assessment. But now the assessment that you're going to be making there is based on the parameters given in unit what? 1.5. So the assessment that you're going to be doing on any potential case study that they give you based on study unit 1, any assessment that you're going to be doing when it comes to the risk management failure is going to be based on the information that we need to learn from unit 1.5. So please go through the article, familiarize yourself with the article. Then after familiarizing yourself with the article, then we can now be able to go through unit 1.5. Because from unit 1.5, you are now going to be now starting to answer the question, is it a fair assessment to say, in this case, risk management has failed? Unit 1.4 is another case study where we are going to be asking ourselves, in this case, is it a fair assessment to say risk management did fail? Because when you look at the case study of ComAir, they say that ComAir is a subsidiary of Delta Airlines, and this is basically what we saw happening in the US. It's based in the US, and you find that when it comes to this, their core problem started from a situation where they were they were moving from one system to another system. So they were migrating from one system to another system, which is the systems that they were using um, to book the airline tickets as well. So you find that they experienced, in the US, they always have those weather conditions where there's snow, and in some cases there's storms and all these other horrible weather conditions as well. So because there was a lot of snow, it resulted in a situation where they were forced to, the planes were being delayed. And as the planes were being delayed at the same time, they had to reschedule some of the flights. So which means that now the system had a maximum number of bookings that it could handle. And because of the bad weather condition, the system reached that number of bookings that it can handle over a given period of time, which basically means that the system crashed. And as the system crashed, it basically meant that the scheduling of the crew was also affected. The booking of the flights was also affected, so which resulted in a big disaster when it comes to the airline as well. So because of this, you are now going to, the question is now going to be, so can it, from what you've seen or from what you've gone through in the case study, would it be a fair assessment to say, in that case, we can say risk management did fail? So these are the 4 case studies that we are being introduced to, but for us to now understand and for one to be able to understand exactly, so would it be a fair assessment to blame risk management, or is there another failure that happened which cannot be blamed on risk management as well? So those are the case studies that are being introduced to us in trying to address the question on whether risk management did fail. So the most important article from these is the article coming from Unit 1.5, because Unit 1.5 looks at what are risk management failures, what are they, and when do they happen. And in trying to demonstrate risk management failures as well, they give us the case study of LTCM. So they give us the case study of LTCM. So we're going to be introduced to the case study of LTCM, and then from there, they tell us exactly what happened, what are the roles of risk management, and also when can we say risk management has failed. So which are the parameters that we need to look into where we can now say, in this case, risk management would have failed as well. Are there any questions so far? Any questions? So when you look at the Unit 1.5, which looks at risk management failures, what are they and when do they happen? You'll see that the under self-assessment, they say, argue the case that LTCM demise was caused by risk management failure, compare the roles and responsibility of risk management and top executive management, discuss the types of risk management failures, and discuss the alternatives that enterprise can consider to prepare for future crises as well. So when you look at these learning outcomes and you look at the article for Unit 1.5, you'll see that when you look at the article for Unit 1.5, when you look at the article for Unit 1.5, it's coming from the Journal of Applied Corporate Finance. And under this, we look at risk management failures. What are they and when do they happen? And looking at these, they say, in media accounts and popular commentaries on the current financial crisis, a constant refrain is that the risk management function in many of the world's largest financial institutions has failed to carry out its responsibilities. To cite just one example, an article in the Financial Times declares it is obvious that there has been a massive failure of risk management across most of Wall Street. In this article, I want to challenge and at least qualify this assertion by examining what it means for risk management to fail. My main aim in these pages is to show that the fact that an institution suffers an extremely large loss does not necessarily imply that risk management failed or that the institution made a mistake. In making my case, I will not spend much time on the current crisis, but instead begin with the collapse of long-term capital management in 1998. And remember, in short, long-term capital management, they are in the article, they refer to it as LTCM. So here they say, most troubling, top executives and investors could continue to expect more from risk management than it can deliver. With this goal in mind, I show when bad outcomes can be blamed on risk management and when they cannot. And in so doing, I offer this what amounts to a taxonomy of risk management failures. I also address the question of whether and how risk management failure can be used to improve the practice of risk management. I conclude that the probabilities of a large losses are measured very imprecisely, and that as a consequence, companies should rely less on estimates of such probabilities and pay more attention to the implication of large losses for their survival. So which means they are going to demonstrate this as well when you look at the calculation of the expected value. So here they are saying, when you look at large losses, even if a large loss has a low or very small probability of happening, your focus as a risk manager should not be on the effect of the probability. So you should not focus on the probability to say, if there's a 1% probability that a large loss is going to happen, your focus should not be saying, because there's a 1% probability, then we should disregard that probability of a large loss. Reason being, because the probability is very small. But you must focus on saying, if there's a 1% probability that the large loss might happen, what if that 1% happened tomorrow, or after 1 year, or after 5 years, or after 10 years? What are the implications to us as a business? And how is that large loss going to affect the going concern of us as a business when that large loss happens? So that's what the author is saying we should focus on as part of the risk management activities. So as I say, among other suggestions, I propose that greater use of scenario planning would allow institutions to do better job of anticipating the likely consequences of low probability outcomes and developing effective responses to them. So which means it's a way of mitigating these low probability outcomes as well. We should use scenario planning. And in study unit 2, we're going to look at scenario planning in detail as well. So we're going to be looking at scenario planning in detail when we go through study unit 2. So here they look at what was the collapse of LTCM a risk management, was the collapse of LTCM a risk management failure. And here, please note that they are giving us this case study. Like what I said, when you look at these case studies that were being introduced here to try to highlight the issue of risk management failures, please note that don't go too much don't worry too much about the specific details to say there was a 43% loss in 1995, and then this happened, and then there was this loss in that year. Understand the context to say what is being discussed and how is it relevant to risk management failures. Don't worry too much about the specific figures, because you don't want to waste your memory space wondering, trying to remember the specific figures, because that's not how they're going to be asking you questions. If they ask you questions based on this, they are going to ask you questions based on what are the roles and responsibilities of a risk manager. Those are the type of questions now that are going to be asked, and now applying them to the case studies. And from this study unit 1 as well, they are now going to be asking you to say, so based on these case studies, so what sort of risk management failures can you identify and identify their implications and how they can be addressed? Those are the typical type of questions that they can be asking you. So when it comes to the specific figures, to say, no, in 1994, they lost this amount, and then this happened, and then finally they ended up losing this. Don't worry too much about it. Understand the context, but don't worry about the specific figures. Are we on the same page? Any questions before we proceed? Any questions? So the reason why I'm going through this case study with you is mainly because in trying to explain the risk management failures as well, they chose LTCM as a case study and use LTCM to explain risk management failures. So because of this, that's why you see that I'm going through this with you, which means that after understanding the roles and responsibility of risk managers, after understanding the 5 risk management failures, that's when you can now be able to now say, okay, after I've gone through the case study for ESCOM, the case study of HHI, the case study of ComAir, the case study of Bennings Bank, can I overall say there was a risk management failure? And what can I identify as the or how can I now be able to say from the risk management failures that have been identified, how do they apply to those specific case studies? Typically, if they bring you this, that's how they would ask you the question. But remember, the reason why I'm saying you don't have to remember the specific information or the specific, because if they bring this question in an exam or in an assignment, they have to give you the case study. Then after giving you the case study, from the using the information that you've now learned in study unit 1.5, you're now going to be applying it on the case study as well, which means that you don't necessarily have to remember this case study in detail. Understand the context, so that when you're now looking at application of risk management failures or identifying the risk management failures, you are able to now understand exactly in which context is it and what am I, these risk management failures, and how can I be able to apply them based on the case study given. So here they say, we now know a good deal about the rise and fall of long-term capital management, or LTCM. In 1994, ex-Salomon Brothers traders and 2 future Nobel Prize winners started a hedge fund called Long-Term Capital Fund. The LTCM was the company that managed the fund. So the fund performed superbly for most of its life, with investors earning 20% for 10 months in 1994, 43% in 1995, 41% in 1996, and 17% in 1997. So if you look at these returns, it's very difficult for any fund to actually generate these returns. So it means that the fund was performing very, very well. But here they say, but 1998 turned out very differently. In August and September 1998, following the default of Russia on its ruble-denominated debt, world capital markets were in crisis, and LTCM lost most of its capital. Before its collapse, LTCM had capital base close to 5 billion, assets in excess of 100 billion, and derivatives with a notional amount in excess of 1 trillion. So as you can see, they had capital 5 billion, but their assets were 100 billion. Remember, your assets is equal to equity plus liabilities. So which means if the assets are worth 100 billion and the capital is 5 billion, so where is the rest of the finance coming from? It's coming from what? The rest of the finance in this case is coming from debt financing. So the use of debt financing is referred to as leverage. So if you are going to be seeing the term leverage in the article, you should know that the term leverage refers to use of debt financing. So what do you see? If the company has assets worth 100 billion and the equity is only worth 5 billion, it means the liabilities are worth how much? 95 billion. So it means the liabilities are worth 95 billion. Now, look, try to comprehend this. If anything happens to the asset or to the income generating activity, because remember, we use the asset to generate income, isn't it? If anything happens to the income generating activity of the business, what does that mean? It means in this case, if there's going to be a loss here, there's not enough capital available to absorb these losses. And the risk now is that if there's not enough capital to absorb these losses, what is going to happen? If the losses becomes higher than 5 billion, it means those with who have contributed debt financing to the business now are the ones who are the most at risk, isn't it? So this is the situation that LTCM was facing. But because the company was doing well, or the enterprise was doing well, generating those big returns, what does that mean? It basically means that everyone was happy, especially the shareholders. We're happy because their return on investment was quite good because they didn't have to generate that, contribute that much in financing. But at the same time, when the returns are good, naturally you expect that your debt financing remains fixed, regardless of the performance of the organization. So which means the debt holders were the ones who were most at risk here because they were contributing the most amount of money. And naturally, you would expect that under normal circumstances, the debt holders, whether the company does well or it does not do well, they get a fixed return. And if they're getting a fixed return, what does that mean? There is no incentive to the debt holders for the company to take on too much risk. But what do we see? The company was taking on a lot of risk by investing in, having investments much in derivatives. Because remember, when you look at how much they were invested in derivatives there, we are being told that the company had in an amount in excess of 1 trillion in what? Derivatives. So what do we know about derivatives? A derivative is an investment instrument that derives its value from the performance of the underlying asset. So a derivative is an instrument or investment instrument or investment security that derives its value from the performance of the underlying security. So which means in this case, the risk there is that the performance of this derivative, if it's going to be dependent on the underlying security, in some cases, the investors might not understand exactly what are these underlying security, because when the derivative is being packaged, it's being packaged as a product, but what you don't understand exactly is what is contained inside that product. So what is the risk of the instruments that are being contained inside that particular product? So which means there was quite a lot of risk that they were taking there. They were using a lot of leverage and investing in derivatives, which are basically instruments that derive their value from the value of the underlying instrument as well. That's why you see that, and with some of the derivative as well, when it comes to the underlying security, you don't necessarily have to be investing the full value of the underlying security. And because you don't necessarily have to invest the full value of the underlying security, it means the risk is basically the risk is either you make multiple gains, or you can also make multiple losses as well. The reason being, the losses and the gains are multiplied because of the use of what? High use of leverage in that case. So here they say, By mid-September, LTCM's capital had fallen by more than 3.5 billion, and the Federal Reserve of New York coordinated a rescue by private financial institution that injected 3.65 billion into the fund. So does a loss of more than 70% of capital and a rescue by banks involving an injection of 3.65 billion of new capital necessarily represent a failure of risk management? It turns out that this is not an easy question to answer. To define a risk management failure, one first must have a clear understanding of the role and the limitations of risk management. So now the question is, if the company is being financed 5 billion in capital, which is the honor of the business contribution, and then they lose 3.65 billion of that capital because of the losses, and they have to be bailed out. So does it mean, or does it necessarily mean that in that case, we can blame the risk management function on the losses in that case? So the next paragraph is a very, very important paragraph because you need, I've seen so many questions coming in short format or in long format where you need to understand and indicate the role of risk management. So please take note, the next paragraph is very, very important. So which means the specific figures here, don't worry much about them. What is more important is this next paragraph here. So here they say, in a typical company, the role of risk management is to identify and evaluate the risk faced by the firm, to communicate these risks to senior management, and to monitor and manage those risks in a way that ensures that the firm bears only the risk its management and board want exposure to. So, to guide them in monitoring and managing risk, most companies specify one or more measures of overall risk, perhaps, along with the metrics and indicators. So when a risk measure exceeds the company's stated tolerance for risk, its risk is reduced. But when the risk is measured falls below the firm's targeted risk opposition, then the firm will most likely choose to increase the risk in that case. So what do we see? What is the role and responsibility of a risk manager within the organization? The role of the risk and responsibility of the risk manager is to identify and evaluate the risk faced by the firm, to communicate the risk to the senior managers, and then after communicating, after identifying and valuing that risk and quantifying that risk, right? They tell the risk managers to say, okay, fine, this is what we've identified. These are the risk exposures that we've identified. But now we know that when it comes to risk can be considered to be conservative. So an investor can be a conservative investor or can have a moderate risk rate. So risk can be conservative, it can be moderate, or it can be aggressive or high risk. Or in some cases, so which means in this case, if the risks exposures can be conservative, moderate, or aggressive, remember we said that the risk manager in this case, their responsibility now is to assess the organization. Then after assessing the organization, they have to identify the risks that the organization is facing. They have to evaluate those risks as well that the organization is facing. Then, remember, as part of evaluating, you need to quantify and indicate exactly what are the implications of these risks as well. And then they can now say, based on what we've identified in evaluating the organization as well, we can say maybe the risk overall that the organization is facing is conservative, is moderate, or is aggressive, right? Then the reason why we say just because large losses, the company can have large losses, we cannot necessarily blame it on the risk managers is mainly because it is also the job of the top management and the executive to now say, based on what you've seen and based on our goal. Remember, there's always going to be a relationship. Generally, there's a relationship between risk and return. There's generally a relationship between risk and return. Generally, the higher risk you take, the higher the expected return, not the actual return. Please take note. When you take on more risk, does not necessarily mean that you're going to be having a high return. But in pursuit of higher returns, know that the higher return, that the more the return that you're pursuing on your investment, the more the risk that you're going to be taking. So which means, because of that, based on this relation between risk and return, the management and the executive are now going to say, we have now made our decision because we are trying to pursue a certain amount. We want to increase our returns, want to increase our earnings per share, whatever it is as well. Maybe we can pursue this investment, which is between moderate and aggressive risk rating. So, which means the risk manager now, remember, the risk managers, they've done the evaluation, but then the top management and executive say, are the ones who are going to make that decision to say, ideally, from the information that we have, this is where we want the organization to be. So because they choose to say, this is where we want the organization to be exposed to in pursuit of this relationship. So it means that if there are going to be any losses that are going to be resulting from here, from this position that you've taken, because we know that the more risk we take, the higher the expected return, which means that in pursuit of higher expected return, there's going to be an expectation that the risk is going to be more as well. Which means if they are having a higher risk exposure in pursuit of higher expected returns, what does that mean? If things go wrong, because remember, the mere fact that there's a risk there, it means that there's a risk that there might be loss, isn't it? So which means if there's going to be a risk there, it means that if things go wrong, people cannot go back and blame the risk manager and say, you, based on this, because of money, we have suffered a loss, it means that it's your fault. As long as the risk manager has identified those risk exposures, has managed to do a proper evaluation of those risk exposures, and has managed to properly communicate the implications of this risk that the organization is taking, then you cannot go back and blame the risk manager, because the risk manager can only do so much. Then, if the top management and executive say, this is the risk that we are willing to take in pursuit of higher expected returns, what is going to happen? It is also the responsibility of the risk manager to ensure that the risk that the organization is going to be taking in its activities. That's why we say instead you need to ensure that the organization stays within these risk limits. So to ensure that the organization stays with within this risk limit that has been set forth by the top management, the risk manager now needs to make sure that in all the activities they are able to keep tabs to say, are we staying within this risk limit? If not, then how do we make sure that we go back to this risk limit? That should be the responsibility of the risk manager. So do you see that just because an organization has suffered a huge loss, is it going to be a fair assessment to blame it all on the risk manager? That's the question. Are there any questions? Any questions? Anyone else? So this paragraph is a very, very important paragraph. Reason being, When you go on to start Unit 2, all the way to start Unit 2023, the question is always going to be, what is the role of the risk manager? Whatever the risk manager is doing, is it within their role? Whatever losses that the organization has suffered, is it a fair assessment to blame it on the risk management department? So here, on that paragraph, they go on to say, to guide them in monitoring and managing risk, most companies specify one or more measures of overall risk, perhaps along with other metrics or indicators. When a risk measure exceeds the company's stated tolerance, the risk is reduced, but when the risk measure falls below the firm's targeted risk position, the firm will likely choose to increase the risk. Why are they increasing the risk if it's falling below? Because remember, there is always going to be a relationship between risk and return. So which means if you're going to be taking a lower risk, also expect a lower return. So which means generally this graph is something like this. So we have risk, yeah, on the x-axis and return on the, I prefer to say expected return, because just because you are taking on so much risk does not necessarily mean that you're going to be having that return. So there's going to be an expected return, which means generally we expect this relationship, whether it's starting from here or it's starting from there or it's starting from there as well, we generally expect this relationship to be something like this, where, for example, it can be having this relationship or it can be having this relationship where when risk increases, expected return also increases as well. So there's always going to be that relationship there, which means that as management is pursuing these higher expected returns, they should also acknowledge that what their risk exposure is also increasing as well. Are there any questions so far? Any questions? So they go on to say, given this definition of the role of risk management, the actual returns of LTCM tell us little about whether its risk management failed. To understand why, it is helpful to consider a very simple hypothetical example. Suppose that you stood in the shoes of the managers of LTCM in January 1998 and had the opportunity to invest in trades that, viewed as a portfolio, had 99% chance of producing a return for the fund before fees of 25% over the coming year, and a 1% chance of a loss of 70%. So the expected return on the fund would be estimated to be that. So which means mathematically, we say your expected return is given as the sum of the expected return of is given the sum of the return of the asset multiplied by the probability of that return. So it's going to be, so the expected return is given as the sum of the return of the assets multiplied by the probability of those returns as well. So what do we see? It basically means that the point that they're trying to drive here is that, as you can see from the information, there is a 99% chance that this portfolio is going to generate a return of 25%. And then there's a 1% chance that this return is going to suffer a loss of 70%. So which means, as a risk manager, when you calculate the expected return, when you do the calculation there, your expected return is going to be 24.05%. So what does that mean? It means if you look at it from just by looking at it, you are very confident that you should be able to meet this return of 24.05%. because 99% of the time, you should be able to generate what? 25%. And only 1% of the time, you should be suffering a loss of 70% on your portfolio. So which means if you just look at it at face value, the investment looks like a good investment because the overall expected return here is 24.05%. But here they say, so such an expected return would, of course, have been a very attractive for a hedge fund or any investor, um, again, provided that the assigned probabilities and other underlying assumptions were reasonably consistent with economic reality. Though hypothetical, these numbers are roughly consistent with the actual returns of LTCM before 1998 and the expectations LTCM was holding out of its investors at the time. For one thing, it is in its two best years, the fund earned more than 50% before fees, so that a return of 25% does not sound implausible. And second, LTCM told its investors to expect losses in excess of 20% in 1 year out of 50, which again is roughly comparable to a loss of 70% in 1 year out of 100. Because remember, they are saying that there's a 1% probability, 1% is 1 over 100, which means they are saying in years' term, in our 100-year existence that we're expecting, so we're expecting that over a 100-year period, it's only 1 year of the 100-year period that we're expecting to suffer a loss of what? 70% of the value of the portfolio. But now the question is, so when would you expect this 1 year to occur? Is this 1 year going to occur after exactly 100 years? Or is it going to occur after 50 years, after 10 years, after 2 years, after 1 year, or after a few months? No, this is where the risk is, where they are. So remember, the author was saying, when it comes to the risk exposures, as a risk manager, don't overindulge yourself in probabilities. Concentrate on the implications of that large loss occurring. So what LTCM failed to do, or account in this case, is what will be the implication of this 70% loss being suffered? How is it going to end up affecting the going concern of the business? So that's basically what the author is now trying to indicate, to say, so when you look at the case side of LTCM, what will be the implications in the case where LTCM suffers that loss of 70% of the value of the portfolio? How is it going to end up affecting the going concern of LTCM? Are we on the same page? Any questions? Anyone lost so far? All right, can you take a 10 minutes break? Can you take a 10 minutes break until 9:30? So can we take a few minutes break until 9:30? Then at 9:30, we continue with the article. So can we take a few minutes break until 9:30? Then at 9:30, we continue with the article. All right. Are there any questions before we proceed? Any questions? Any questions or comments before we proceed? All right. Now, continue with the article. They also go on to say, or the author goes on to say, as stated earlier, then the main responsibility of risk management is to assess the firm's risks and then communicate that assessment to top management. And the final decision to take known risks rests not with the risk manager, but with top management. So this decision depends on the risk appetite and tolerance of an institution, and defining that appetite is one of the most important responsibilities of management and the board. So which means defining the risk appetite of the organization and the amount of risk that the organization should take is not the responsibility of the risk manager, it's the responsibility of the top management and the board. So here they say, it is at the heart of the firm's strategy and how it creates value for its shareholders. So remember we're saying, after everything is said and done, the organization always have to ask itself, what is the goal of the firm? The goal of the firm is to maximize shareholders' wealth. How to maximize shareholders' wealth? By ensuring that in every activity that the enterprise is pursuing, they are creating value for the shareholders. And how is that value for the shareholders reflected when you look at creation of that value? You look at the value of what? The value of the shares. For example, if the company is what? Traded as well. So let's say, when determining the risk appetite of an organization, the general approach is to weigh the benefits of increased risk taking against the cost and to maintain, to aim for the point where the marginal benefits equal the marginal cost. So which means with every economic decision that anyone makes within the organization, the benefits must always be more than the costs. So the benefits must always be more than the costs. The worst case scenario is where you make a decision where your marginal benefits are equal to your marginal cost. Because if your marginal benefits are equal to your marginal cost, it means you are maintaining the value of the firm. So which means the minimum expectation with every economic decision that one makes for an enterprise is that you must either maintain the value of the firm or increase the value of the firm. And how do you do that? By making sure that your benefits are more than your costs. Worst case scenario is making a decision where your benefits are equal to your costs. And in that case, this is how you're able to maintain the value of the firm. So let's say, in the case of LTCM, it could be argued that the cost to the organization from losing 3.5 billion for its investors was limited to just those losses. That is, there is no additional cost beyond the direct monetary loss. For many companies and financial institutions, however, large losses can have significant deadweight costs. For example, after a large loss, a financial institution may be forced to scale back its investments and sell assets in unfavorable markets. So which means when they're talking about selling assets in unfavorable markets, this is where you know that you're selling these assets at a loss. Why? Because you are not able to hang on to these assets anymore, even though you might be expecting that maybe after 1 year, if you ride off the wave, the value of the asset would have gone up and then we sell them at a higher price. But because you're in a situation where you are not able to continue as a going concern because you have all these losses that you're facing as well, you're going to be faced to sell these losses, assets at a loss. Hence, what? In unfavorable markets, where the value of the assets is basically on the downward. And first, increased scrutiny from regulators, lose valuable employees and customers concerned about the institution staying power, because the customers, they are worried about the supply of the goods and services that they're getting from the organization. So which means if they're worried about your going concern, what is going to happen? They're going to now start considering what? Other suppliers as well. And the employees are worried about their job security. If the company is not able to continue to going concern, what is the risk? They're going to end up being retrenched. So which means these are some of the deadweight costs of large losses to an organization. So in any institution, management and the board must take account of such deadweight costs when making decisions that create the risk of large losses. So again, it is top management's job to determine a company's risk appetite. And taking that appetite as a given, risk managers can help assess the expected profitability of a proposed investment by evaluating how much capital is required to support it. So also worth noting, an investment that is not value adding for a given level of risk and could become so if the firm's risk appetite increases, because less capital is then required to support it. But whether taking large risks is worthwhile for an institution ultimately depends on its strategy, which in turn depends heavily on the risk appetite. And remember, when it comes to analyzing more in detail, when it comes to the risk appetite of the organization, we are going to be looking at it in study unit 9 as well. So as they say, and risk managers, as already suggested, do not set either. So both strategy and risk appetite are the prerogatives of top management, which means the risk appetite and the strategy that the organization needs to take. It's not the job and responsibility of the risk manager. It's the job and responsibility of the top management and the board. So to illustrate this point, suppose that a company follows the common practice of setting its risk tolerance by choosing a target credit rating. Once the target rating is chosen, there are multiple combinations of risk and capital that can be expected to achieve the target rating. For a given choice of leverage, the firm does not have much flexibility in choosing its risk level if it wants to achieve its target rating. So if faced with promising investment opportunities that would increase risk, the firm has two main choices. It can choose to reduce leverage, that is the financial risk, while taking on more business risk, or to keep its rating, or it can maintain its leverage and accept lower credit rating. And there's also, of course, a third choice. Maintain both the credit rating and existing leverage, but at the cost of passing up the investment opportunity. Because remember, business risk, financial risk, all contributes towards the overall risk of the organization. So which means there has to be a balancing act to say, for us to achieve the overall risk of the organization, should we maintain business risk and financial risk at the level they are? Or should we lower the business risk and increase the financial risk? Or should we lower the financial risk and increase the business risk? So it's more like a seesaw in trying to achieve that optimal risk level that the organization wishes to maintain. So as they say, at the end of 1997, LTC made capital of 7.4 billion, but decided to return 36% of the capital to its investors. Remember, 1997 is before the disaster year of 1998. So do you see that in 1997, before the disaster, LTCM was sitting with a capital of 7.4 billion, but decided to return 36% of the capital to its investors. So which means they basically had like a share repurchase program. So what does that mean? When they return 36% of the capital to investors, what does that mean? Going back to our accounting equation, Your assets is equal to equity plus liabilities. If you lower your equity, what does that mean? The percentage of your debt is going to increase, isn't it? So if you lower your equity, so if your equity goes down, the value of the percentage of debt as a percentage of what? Of the total financing of the business goes up. And if the debt goes up, it means the leveraging of the company also goes up, isn't it? Which means the lower the percentage of equity that the company has, because they are basically doing a share repurchase program in this case, it means that they're expecting the percentage of debt, that's in this case, as an overall percentage of the assets of the business to increase. And when leveraging increases, financial risk is also expected to increase. So which means leverage is linked to financial risk. So which means the more debt financing a company uses, the higher the leverage. And the higher the leverage, the higher the financial risk that the company is facing, and vice versa. So which means in this case, the company in 1997, because they had that share repurchase program, what does that mean? It means their financial risk also increased. And remember, when equity goes down, what does that mean? It means equity is used as a cushion to say if there's going to be any losses suffered here, the equity is going to absorb those losses. Why is the equity absorbing those losses? To maintain the going concern of the business. So which means in this case in 1997, if the company decides to lower the equity available, it means the cushion available to the cushion available to absorb those losses in case those losses happen is evaporating, isn't it? And what would that mean as well? It means the going concern of the business is at high risk. But at the same time, what do we know? When equity goes up, there is what they call in finance return on equity. Your return on equity is your value of equity divided by your net income. No, it's the opposite. It's your net income divided by the value of equity. That's your return on equity. And usually you multiply that by 100 to make it a percentage. So what would that mean? If the equity value goes up, so if the equity value goes down, what would it mean on the overall return on equity? You're expecting the return on equity to go. So which means because they were trying to squeeze as much as possible by increasing the financial leverage of the business. So by increasing the financial leverage of the business, they were not through lowering of the value of equity. What did it do? They were doing that in pursuit of increasing the return. But we know the higher the risk you're taking through leveraging, which is the financial risk here, we know that you are pursuing higher expected returns. So they were taking more risk in pursuit of expected return, and in this case, the return on equity. So they're trying to increase the return on equity as much as possible. And remember, over the past 3 years, they were having the golden years where some of their returns were even going more than 50% return. So they're pursuing even more returns in that case as well. But now, what do we see? With less capital, LTCM could still execute the same trades, but to fund them, it had to borrow more and hence increase its leverage. By increasing its leverage, it could boost the return to its shareholders, which is the return in this case is the return on equity, as I've demonstrated. If things went poorly, if things went well, but only by raising the expected losses if things went poorly. So which means leveraging can exponentially increase your gains, but the downside of it is that it can also exponentially increase your losses. So here they say, Was increasing leverage a bad risk management decision? In my example, I assume that the partners of LTCM knew the risks and the rewards from higher leverage. So in the well-known language in financial economics, increasing leverage appeared to be a positive net present value decision when it was made. But ex post, which is after the loss event has happened, or after the fact, it proved to be a costly decision since it meant that when assets fell in value, the value of the equity fell much faster as well. So which means because of this, because they increased the leverage, are we going to blame the risk manager? Is it a fair assessment to blame the risk manager in this case? So let's say, in sum, effective risk management does not provide a guarantee against failure. Even in companies with the best risk management, people and systems, large losses can and will occur as long as taking risk of large losses increases expected profits sufficiently for top management to be willing to take that risk. So with good risk management, such losses will be attributable to an unlucky draw, to a 1 in 100 event. Ultimately, how likely such losses will depend on how such losses will depend on the choices made by those entrusted with the determining the firm's risk appetite. So the job of risk management is to ensure that top management knows and understands the probabilities associated with the possible outcomes of the firm's strategy before they make decisions to commit the firm's capital. Please take note of this. I'll emphasize. The job of risk management is to ensure that top management knows and understands the probabilities associated with the possible outcomes of the firm's strategy before they make the decisions to commit the firm's capital. So which means they must make sure that they properly communicate the risk exposures to the top management before the top management now make that decision. Any questions so far? Any questions? Now, when you look at the taxonomy of risk management failures, so now we're going to say, so how do we now say, if we identify any one of these factors, we can now say, yes, there was a risk management failure in that case. So here they say, as this discussion suggests, then there are 5 types of risk management failures. The first one, failure to use appropriate risk metrics, which we are going to discuss in detail. The second one, mismeasurement of known risks. And then the third one, failure to take known risk into account. And fourth, failure to communicating risk to top management. And then the fifth one, failure in monitoring and managing risk. I now discuss each of these failures in turn. So starting with the first one, risk metrics and risk management failure. So now we are going to be starting off with failure to use appropriate risk metrics. So we're going to be starting off with failures to use appropriate risk metrics. So which means in this case, they say the risk metric that is mostly closely associated with modern risk management is value at risk. So VAR stands for value at risk. So when you look at the definition of value at risk, they say the daily value at risk measure is widely used in financial institutions for assessing the risk of trading activities. Though value at risk is proven to be an extremely useful risk measure, it is useful only as long as the question it answers is well understood. Value at risk is the largest loss the firm expects to incur at a given confidence level, which means that the value at risk tells us nothing about the distribution of the losses that exceeds the value at risk. So this limitation of value at risk has nothing to do with how institutions estimate their value at risk. Rather, it is simply a matter of how value at risk is defined. The value at risk is an estimate of the minimum worst loss expected as opposed to the expected waste loss. Remember, the expected waste loss, by definition, although in Rsk4803 we don't talk about it or we don't discuss it, the expected the expected waste loss in that case, we refer to it as the expected shortfall. But we're not going to look at it in Rsk4803. We're going to look at it now in Rsk4805. That's when we are going to look at it in detail. So let's say, though appropriate for some purposes, value at risk is likely to be useless for others. So it's not all the case where you're going to be finding the value at risk appropriate. And going back to the case study of LTCM as well, they were saying that when they did the calculation of the value at risk, they were saying that the expected waste loss is so much, so which means that they were anticipating that the worst case scenario, the value of this, the value that we're expecting to lose over a given period of time is so much. But now, what they didn't take into account is exactly what if those losses exceed that value at risk amount? How much are those losses that we're expecting to incur, those losses that exceeds that that value at risk amount? So that's one thing that they failed to use, which means that in this case, if you don't use the right metric in assessing your risk exposures as well, it might seem as if you are not that you are basically able to manage your risk, but at the same time, if you fail to take into account other metrics to see exactly what your exposures are, what is going to happen? If the losses happen, it means that you might end up having a situation where it end up affecting the going concern of the business. So let's say that's the calculation of the daily market value at risk can be intellectually satisfying for risk managers, since it involves up-to-date quantitative techniques. An excessive focus on it could lead risk managers to ignore critical dimensions of risk. So the daily market value at risk should generally not be the primary focus of top management, which must pay attention to longer run indicators and implications of risk. So as I show with an example below, short-run value at risk measures can continue to mislead management by suggesting low risk until a series of events produces a huge loss and the firm ends up failing as well. Any questions so far? Any questions? The next risk management failure that they discuss is mismeasurement of known risks. Is mismeasurement of known risk. And here they say risk managers could make a mistake in assessing the probability of a large loss, or they could be wrong about the size of the loss given that it takes place. Or they could use the wrong distribution altogether. Further, in the case of financial institutions with many positions, although the distribution associated with each position may be estimated properly, the correlation among the different positions may be mismeasured. Such correlations are extremely important in risk management because as correlations increase, so does the vulnerability of the portfolio to low probability events. So what are they talking about when they talk about correlations? They're basically saying, when you look at your correlation coefficient, your correlation coefficients varies between -1, 0, and +1. So the correlation between any two events or any two outcomes, they are always going to be found within this range. When the correlation coefficient is -1, we say they are perfectly negatively correlated. When they are at +1, we say they are perfectly positively correlated. And when it's zero, we say there's no linear correlation. So we say there's no linear correlation. So when the correlation coefficient is at zero, we say there is no linear correlation. So which means when you analyze the correlation coefficient between two variables, we are basically saying when you analyze the terms between these two variables, so when something is perfectly negatively correlated, we are saying when you're analyzing their relationship, let's say we look at the movements of security M. We are saying when they're perfectly negatively correlated, we are saying that when one goes up, in this case, when M goes up, N goes down. So which means we're saying they are moving in this direction. So which means when one is going up, the other one is going down. And when one is going down, going up here, the other one is going down. So which means they are moving in opposite direction. So that's when we say these two variables are perfectly negatively correlated. Then when the variables are perfectly positively correlated, it means when you look at their relationship, remember we said M is going in this direction. When they are perfectly positively correlated, we are also saying that when M is going up, N is going up. And then, so they are moving in something like this. Although my diagram is not as clear, but we are saying that they are moving in something like this, where when M goes up, N goes up. When M goes down, N goes down. And when M goes up, N goes up. So which means they are moving in sync. So they are moving in sync. So now, when you talk about risk management, ideally, as a risk management activity, you want to make sure that when you look at the relationship between variables, the relationship to be between different variables should be as close to -1 as possible, because the more at -1 you are, the more diversified you are. So which means when you look at diversification, you are well diversified or fully diversified when the relationship between the variables is closer to -1. Reason being, you are avoiding a situation where your variables are perfectly positively correlated. Because if they are perfectly positively correlated, what is going to happen? We're basically saying that when one suffers a loss, the other one is also going to suffer a loss. So which means if both of the variables or your products that you have in your portfolio suffers losses at the same time, what is going to happen? It means that your losses end up being compounded, resulting in what? Large losses, which is what we're trying to avoid in management. So in risk management, the aim is to ensure that when you look at the relationship between two variables, the relationship should be as close to -1 as much as possible. The closer the relationship is closer to -1 as much as possible, the lower risk you're taking because you are diversified. Are we on the same page? Any questions? So which means when you look at any two events, you must try to ensure that their correlation is closer to -1 as much as possible. The more positive their relationship is, the higher the risk that you're taking. That at the same point in time, if one suffers a loss, the other is also going to be resulting in a loss as well, which means that those losses end up compounding into a large loss. Are there any questions? Any questions? Anyone lost? Now, we look at in mismeasurement of known risks, we look at the limits of risk measurement. And here they say, to sum up, then statistical techniques are generally used to estimate the distribution of known risks. Such approaches work well when there is a lot of data and when it's reasonable to expect future returns to have the same distribution as past returns. For instance, suppose that a risk manager wants to estimate the volatility of the return of a liquid stock. She will have hundreds of data points to fit a model of the volatility of the stock, and in most cases, that model will perform reasonably well. But in other cases, historical data will be of little use, say, because as a risk has not manifested itself in the past. So here they say, when you look at mismeasurement of non-risk as well, that basically means that there is limits to the risk measurement. Reason being, in some cases, you might find that if it's something, if you're measuring the risk of something that is occurring regularly, it's reliable to use historical data to measure the risk as well. But if you're measuring the risk of something that is not recurring, it's going to be very difficult to use to measure that particular the effects of that risk as well. Like as a good example is where you look at the 2007-2008 financial crisis. Remember the 2007-2008 financial crisis, the the effects there were emanating from the real estate effects, isn't it? They were basically emanating from real estate. And you'll find that before 2007-2008 financial crisis, it was very difficult to find any historical situations where large losses were suffered because of what? The effects emanating from the real estate crisis as well. Because remember, before 2007, 2008 financial crisis, the losses there that was suffered previously, I think it was 2000, around year 2000, where there was a dot-com crash as well, which is basically emanating from the IT, and which means that because of this, it's going to be very difficult now to measure non-risk when there's no historical data available to use in measuring that risk effects as well. So that's basically what they look at when you look at the limits of what? Risk measurement. Then they also look at mismeasurement stemming from overlooked risks. And yet they say, now let's turn to a different kind of mismeasurement, of measurement failure. Failure to take account of risks. In my taxonomy, such ignored risk can take two different forms that have different implications for a company. First, a firm's risk manager may ignore a known risk, perhaps because of a mistaken assumption that it is immaterial or because of the difficulty in incorporating it in the risk models. So second is the case of risks that are truly unknown or at least completely unanticipated. So which means if the risks are unknown and truly unanticipated, it basically means that you end up having what? Mismeasurement of those risks or overlooking those risks. So because you are not taking them into account because you have not incurred such situations before as well. Then we look at ignored known risks. And here they say, let's now consider the case of risk management failure in which material risks are known to at least some people inside the firm, but not reflected in the firm's risk models. So in a well-functioning, truly enterprise-wide risk management system, all major risks would be identified, monitored, and managed on a continuous basis. In practice, of course, many corporate risks tend to be managed in decentralized silos, which increases the possibility that non-material risks are excluded from the central risk modeling process. So when this happens, risks that are not captured by the system are not adequately monitored. So, and given the tendency of unmonitored risk to expand within large organizations. Such risks can become material if they weren't before. So here they say some firms prohibit trading of financial instruments unless they are properly modeled. But such a choice has cost since it is often extremely valuable for traders to be active at the beginning of a new market. However, if the financial instrument is not included in the models, traders are tempted to build up positions in these instruments, creating the possibility of large losses. So which means here they are saying, when you look at the implications of ignored non-risk, they are basically saying, in some cases, a company can be pursuing new markets, and as they are pursuing new markets, remember, there's always going to be that trend where if you are the first one to invest in a particular market, you are more likely to be the one who achieves the higher growth and higher returns. But now the risk is if those risks in those markets are going to be ignored or not accounted for on time when you are now trying to have that balancing act to say, so should we hold everything or any trading in that particular market and do the assessment first? Or should we allow our traders to jump in, be the first ones in there? Or should we allow our company to invest in this particular new market as well and be the first, but then measure those risks as we go? What is going to happen? It basically means that the company is now running the risk where they have not accounted for these risks because they have not given them enough, given the risk manager to actually do the assessment and evaluation of these risks as well. And at the same time, the risk is that if anything goes wrong, this is where some of these large losses are also going to end up emanating from as well. Then they also discuss unknown risks. And yet they say most unknown risks do not create risk management problem. But at the same time, they also go on to say unknown risk may not matter simply because they have a very low probability. For example, there is some probability that a building will be hit by an asteroid, but such a risk does not affect managerial decisions. The unknown risks that matter for our purpose are those that, had top management been aware of them, would have resulted in different actions. So in sum, part of the risk manager's job is to think hard about all major sources of uncertainty, perhaps using scenario planning as a methodical way of identifying and anticipating unknown risks. We are going to look at scenario planning in study unit 2. But having said that, some risks will inevitably remain unknown until they actually materialize. After all, how many corporate risk managers anticipated the events of 9/11? And acknowledging this possibility of unknown and unknowable risks, risk managers at some point must concede the limitations of their models and perhaps recommend that additional capital be set aside for this possibility as well. So that's what we need to take into account when you look at mismeasurement of non-risks as well. We also look at communication failures as another risk management failure. And then they say risk management is not an activity undertaken by the risk managers for the benefit of risk managers, nor should it ever be viewed as an operational or profit center unto itself. Instead, it should be designed to help the firm maximize value by protecting its ability to make the optimal investment and operating decisions. So the role of risk management in such strategic decisions making is to provide timely information to the board and top management that allows them to assess the consequences of retaining or laying off risk. But for managers and boards to understand such risks, their consequences for the firm's operations, risk managers must communicate effectively. So which means we are saying the risk manager must ensure that they communicate these risks to, they must evaluate, identify, evaluate, and communicate these risk exposures to the board and top management, right? So which means the board and top management now, when it comes to these risk exposures, they have two options. They have two broad options which can be managed by having a hybrid approach as well, where they can choose to retain the risk or they can choose to transfer the risk. And remember, if they choose to retain risk, we are going to look at this in detail in unit. So in unit 11, this is where we're going to look at it in detail. Remember, we said the risk manager identifies, evaluates, and communicate the risk exposures to the board, isn't it, right? And top management. So the board will now have to choose to say, should we retain the risk or should we transfer the risk? So if they choose to transfer the risk, this is where we're going to be looking at it now in study unit 15. So unit 15, if they choose to transfer the risk, we're going to look at it in study unit 15. But now, we also see that this choice, what do we see? If the company chooses to retain risk, it means they have a high appetite for risk. It means they have a high appetite for risk. And if they choose to transfer the risk, it means they have a low appetite for risk. Now, not all the time that you're going to find a company that is with a very high appetite for risk, or a company that is a very low appetite for risk. Remember, we said your risk can be conservative, which is where you are sitting with a low appetite for risk, or it can be aggressive, which is where you are sitting at a high appetite for risk. Now, start unit 12, unit 12, 13, and 14. And in start unit 11, we also look at the use of deductibles. It means that instead of being fully having a high appetite for risk or fully having a low appetite for risk as well, there's also different ways that an organization can find itself somewhere in between the two. And this is what we're going to be looking at in discussing when we look at deductibles in start unit 11, and we also look at alternative risk transfer in start unit 12, 13, 14 as well. So do you see that how these study units are now being interlinked to each other as well? They are being interlinked to each other, so which means that all the study units that we're going to be doing, the foundation is being laid out in study unit 1. So which means from out of laying out the foundation in study unit 1, everything that you're going to be building on as well is going to be used as a base for what you're going to be doing in the other study units as well. Are we on the same page? So which means they must make sure the organization or the top management and the board must ensure that they are the ones who make this decision. And to help them make decision, we are going to look at see what do they need to take into account as well. So which means, but before they make this decision, the risk manager must ensure that they communicate clearly the risk exposures so that when the risk exposures are communicated clearly, they can now, depending on the strategy of the organization and the risk appetite, they can now be able to make that choice as well. Next, we look at failures in monitoring and managing risks. And then they say risk management is responsible for making sure that the firm takes the risk that it wants to take and not others. So as a result, risk managers must constantly monitor the risk that the firm is taking. Further, they have to change and otherwise manage known risks to meet the objectives of top management. So when we discuss that problem, we focused on it as an inventory issue, that is, as a matter of identifying and measuring risks that are fairly stable. Such an approach is likely to be well suited to industrial companies where risks tend to change slowly. But it may have to be modified for financial firms where risk can change abruptly, even if the firm does not take the new position. So, which means in monitoring and managing risk as well, one of the issues that you have to take into account is when you are monitoring managing risk, what the risk, these risk exposures, what type of a company or firm is it? Is it an industrial firm, which is basically, for example, the firm that is in producing and manufacturing goods, or is it a financial firm, which is basically, for example, a hedge fund in that case? So you will see that for a company that is producing and manufacturing goods, the risk factors don't change as abruptly as changes in a financial firm. Because in a financial firm, if the market crashes today, the implications are going to be felt today. But when it comes to an industrial firm, because the implications are going to be felt, because maybe the price of the goods and products are going to be changing, the demand for the goods and products are going to be changing because people are being recruited, and on the implications on their customers as well. It means the changes are not as abrupt as changes are felt by the financial firm as well. So which means that the level of monitoring and managing of the risks as well is going to be a little bit different depending on the firm. Then they also say the problem arises from the fact that financial firms have many derivative positions and positions with embedded derivatives. So the risk properties of portfolios of derivatives can change very rapidly with no trading whatsoever. And this is because complex derivatives have exposures to risk factors that are extremely sensitive to market conditions, because you can wake up and start a day, everything is normal in a financial firm, but if things change during the course of the day, there's going to be drastic changes as well. So in large complex organizations, it is also possible for traders to take risks that remain hidden for a while. Such positions could be constructed with securities whose risk escape detection, at least for a time, by even the best designed risk management models and systems. So how can this happen? All organizations are forced to make trade-off, and risk management is no exception. A company's risk management function could, at least in theory, be designed to know everything at all times. But if it were organized that way, the risk management function, besides being hugely costly, would likely stifle innovation and reduce the competitiveness of the firm. So in fast-moving markets, employees need flexibility. But it suggested the same flexibility makes it possible for unobserved pockets of risk to emerge. And when such risk management manifest themselves, it is not clear that they represent a risk management failure. So although risk management could have ensured that these risks were not taken, the firm and its shareholder would have been worse off. And even ignoring its effects on flexibility and innovation, improvements on risk monitoring are expensive enough that at some point they cease to be cost effective. One final point here, the effectiveness of risk monitoring and control depends crucially on an institution's culture and incentive. If risk is everybody's business, it is harder for the major risk to go undetected and unmanaged. And moreover, if employees' compensation is affected by risks, they will be more judicious in taking them. The best risk models in a firm with limited incentives are likely to be much less effective than in a firm where the incentives of employees are better aligned with the risk-taking objectives of the firm, which means at the end of the day, effective risk management is achieved if everybody contributes towards risk management of the firm, which means even the cleaner within the organization should also not just say, just because I'm the cleaner, I'm not going to be worried about any risk exposure, to say if there's something in the wrong place, maybe someone has left something, a heater in the workplace. Just because my job is a cleaner, I'm not going to worry about what is the implication of this heater. It can burn everything. Or just because I'm a cleaner, I'm going to, if something happens and the security guard is not there, I'm just going to allow people to just walk in without any form of what? Security, and take things from the organization as well. So which means at the end of the day, the effectiveness of risk management boils down to the culture within the organization. If the organization has the right culture, it means that the risk management function is also going to be more effective as well. So that's basically what they're saying. So which means from unit 1.5, what have you taken note of? The most important thing that we need to make sure that we take note of there is the roles and responsibilities of the risk manager. So we need to take note of the roles and responsibilities of the risk manager. And I've seen this question coming in a lot of times from a multiple choice question, true or false answer, or from a case study type of question where you are asked to now discuss the roles and responsibility of the risk manager, and over and above that, indicate where risk management failed. And how do you identify where risk management failed? By taking into account the 5 types of what? Risk management failures. So based on these 5 types of risk management failures, which means if the question comes in the exam where they give you a specific case study, in assessing that particular company as well, you are going to be going back to assessing risk management failure by identifying these 5 types of risk management failures specific to your case study. So do you see why I was saying you cannot look at ESCOM in assessing the risk management failures and say, in assessing risk management failures for ESCOM, for HHI, for ComAir, or for Bearings Bank, because you can only be able to assess these different case studies after you've understood what are the roles and responsibilities of the risk manager, 1. And 2, what are the different types of risk management failures? So that if we identify these risk management failures, we can now say, confidently say, yes, based on what we've observed, we can say there was a risk management failure in that case. Are we on the same page? Any questions? Anyone lost? So which means with regard to risk management failures, expect that in the exam, if you're going to be asked about the risk management failure and they give you a case, referring to a case study, in the body text of the question, they will give you the information of the case study. Then based on the information of the case study, that's when you're now going to do the assessment to say, what are the roles and responsibilities based on the information given on the case study? And how can I identify the risk management failures for us to say, yes, there was a risk management failure which resulted in such amount of loss to the organization as well. So we're ending here today. In the next class, we're going to look at unit 1.6, then move on to unit 2 as well. So we're going to finish off unit 1.6 where we look at the VUCA acronym. And then from there, we move on to unit 2. Are there any questions on what we've covered today? Any questions? All right. If there are no questions, we are ending here today on unit 1.5. Please note, by Monday, end of day, the video will be uploaded. So the video is going to be uploaded by Monday, end of day, so that you're able, in case you want to go back to it, there's something that you missed that you want to go back to, you are going to be able to go back to it as well. Remember, in the previous class, we also demonstrated how to access the articles as well. There is a way that you're able to access the articles. I've shared as a video link on how, during the orientation video, how to access the articles. Please have your articles in order so that you once you have your articles in order, you're not going to be lost as we go through the curriculum as well. Yes, I see there's a question.
Morning. I just wanted to ask, how do we download the slides on the website? Because I've been trying to do that, but it does not give me any option to download them
You mean
to
the
my
articles?
not the
Which
articles, the
laptop
study units.
Usually, if you click on the link, well, remember there are different topics. Topics 1, 2, 3, 4, 5, and 6, isn't it? If you click on the link on topic on the link for topic 1, there should be a PDF document showing immediately on my minister. If which laptop are you using? Are you using a work laptop?
No, it's my personal laptop. I don't know if I
Okay,
can
if you're
project and you can see. I don't
all
know if
right,
it's
just
possible for me.
can you communicate with me after 5? Then I'll just guide you
Okay.
through. But I don't think it should be a problem. Worst case scenario, I'll just forward you an email with the information as well.
Okay, thank you.
But preferably, I want you to be able to access that. Let's talk after 5. Just communicate with me on WhatsApp after 5, because I want you to be able to access that material, not just this, because the lecturer is going to be posting more information that you need to access on that website as well. So you should be able to get that information by yourself. But if you're struggling, just send me a WhatsApp message. Then after 5, after my classes, we can communicate.
Okay, no problem. Thank you.
All right. Are there any other questions? All right. Enjoy the rest of the weekend.